So India is one or India is two inventories. India is two presents accounting treatment of inventory such as determination of cost and subsequent recognition on expenses, including return down value of inventories and net realizable value and reversal of return down. What are you saying? So, determination of cost. What is the cost of inventory? Then what you want to recognize, what are the recognition you should have, expenses, what is the expenses to bring it into it, excluding return on value of inventory. I mean, return on value will be falling down because of its iteration of goods and not realizable value. So net realizable value, what is the net realizable value? So we may bought for 100 rupees, but the valuation gone for 90 or 80 or even 150. So what is the market value you should give? So as per the inventory policy, whichever is less, but net realizable in the case of lesser value, and reversal of return down. Sometimes you would have returned down earlier, but the valuation has been increased because of the market value. These are the reason in the case of inventories. Excluding inventory not are dealt under the indices to what the financial instrument cannot be inventory, biological asset related to agricultural activity cannot be inventories, agriculture product at the point of harvest cannot be inventory. An exception for the measurement of principal India is two for inventories held by what the producer of agricultures and exception. Sometimes some exemption is given for producer of agriculture and forest products, agriculture produce after harvest, minerals and mineral product to the extent they are measured at net realizable value in accordance with well established practices in those industries. So someone who has a good knowledge of what is the value of a goods, and in the case of agriculture and mining activity, after that has been mined, it's ready to sold. In that case, that can also be included in the inventory. Exemption to the exemption this case. Commodity broker trader who measure the inventory at fair value less cost to sell. What commodity broker traders are? Some in case of MCX, cotton mills, these kind of things that we given uh, at the rate they have the product and they had given this product to sell in the market, so they have fixed the rate even though the harvest has been done or the future is waiting for the price, they have done the harvest. In that case, also inventory in ES2, in ES2 will apply. Changes in the fair value, less cost to sell. So always value minus cost to sell. That is the inventory value. Or in the net realizable value, what is the value which is lesser? And such inventories are recognized in profit or loss in the period of change. Inventories are asset. Yeah, inventories are asset that usually current asset you will take held for sale in ordinary course of business is inventory. In the process of production of sales in ordinary course of business is inventory in the form of material, form of supplies to the to be consumed in the production process or rendering of service. I'm going to render some service, so I'm going to produce something, and that in that this is the inventory. Do not include spare parts. Spare parts cannot be inventory. Service equipment cannot be industry. Standby equipment cannot be inventory. This all comes into assets category, but contain fixed assets, but they can't be considered as inventories. Plant property equipment as per Ind AS 16. Measurement of inventory, lower of cost or net realizable value, lower of cost and we want to see cost. What is the purchase that include purchase value, the point of say point of bringing into the place, the price plus other cost will be into the cost. Net realizable value is equal to the this cost minus with return down value or with the cost of sales. What will be the cost of selling it? Cost of selling it, that is also be subtracted in both cases. This will become the value of inventory, whichever is lower. Both of it, what is the lowest value, will take it. So cost of inventory include cost of purchase. What is the purchase value taken? Cost of conversion. And, I have converted the raw material to sellable finished goods. That conversion cost of bringing inventory into present location condition. From the location A to location B, I brought this goods. For this transportation, this cost is involved. That is also included in the cost of inventory. The net realizable value. What is net realizable value include estimated selling price. I have provided a selling price for this good. And in the ordinary course of business, less. It is in the ordinary course of business, not an extraordinary course. We can't overestimate it. Fair value and estimated cost of completion and the estimated cost of necessary to make it sell. I want to sell it. What will be the selling cost? After subtracting it, I come to this. That is that is net realizable value. The cost of purchase. Cost of purchase. What is the cost of purchase? Purchase price excludes trade discounts, rebate, etc. So the purchase price should exclude, you should subtract the trade discount, you should subtract the rebate. Import, you should add back import duties and taxes to the extent of non-refundable. GST, you should can claim input, you should add it. But if it is you can't take input out of it, you can add that customs duty you pay that you can add it, cess you can pay, you add it to transport and handling cost directly attributable. You should be able to determine this is the transportation cost for this goods, and you can have it. Other expenditure directly attributable to acquisition. To get this, you have another expenses. That expenses you can want to add, you can add it. Cost of conversion. What is the mean cost of conversion? Allocation of fixed production overheads based on normal capacity. So I bought this raw material and I made it to finished goods. In this process, I have spent something. So this is to be attributable to this specific finished good. You can add it. Variable production overheads assigned to each unit production on the basis of actual use of production facility. So not only there are variable goods and fixed cost will be there. So that's how you're going to put into fixed cost. This cost auditor will take care of it, but you should know about it. Okay. Examples of cost exclusion. Some cost should not be added. What abnormal cost should not be added. Storage cost unless necessary. Production process prior to further production stage. So I produced something and that I'm saving in a warehouse. So whether the warehouse cost will be included in the cost of raw material? No, you are saving. It's your that is other cost that is not to be attributable to the stock. It should be excluded from the stock. Selling and distribution cost. I want to sell this. So for selling this, I'm making promotional expenses. Do a promotional expense to be added to this cost of the goods? No. Administrative overheads that do not attribute to bringing the inventory to the present location condition. So I having 10 staffs in my company. So do I need to add the company's salary to the cost of the goods? No, because they're administrative expenses. So only that expenses that to bring to the location, that is bring to the place where you want to sell. No, from the raw material to finished goods or one location to another. Other than that, you can't attribute it to cost. And the selling cost you can never add it to that. So material and other supplies held for use in the production of inventories are not written down because below cost if the finished goods is which they will be incorporated. Come again. I'll come again. I lost the question. Sorry. Sorry. Materials and other supplies held in the use in production of inventory. So something you use raw material you use to bring the finished goods that the material supplies are not written down below the cost if the finished product is which they will be incorporated as expected to be sold at above the cost. So that should not be incorporated below the cost. Okay, written down you should not reduce that, and it should be expected to sell above the cost mostly. However, when decline in the price of material indicate that the cost of finished good exceeds the net realizable value. So I have the finished goods that finished good actual cost is 100 rupees, but the market value of the good is only 95 rupees. Then the materials are returned down to net realizable. Then you can should work on 95 rupees, not 100 rupees. In such circumstances, the replacement cost of the material may be the best available measure in the net realizable value. So replacement cost. What is replacement cost? You want to replace this product to other product. What is the replacement cost? That you should understand. When the inventories are sold, the carrying amount when inventories are sold. So they're going to sell it. The carrying amount of inventory shall be recognized as expenses in the period in which relevant revenue is recognized. So this should be when we have a closing stock. A closing stock is sold, then what? It should be booked as expenses. Yeah, carrying amount is expense. Amount of return down of inventory, net realizable value, and losses of inventory shall be recognized as expenses in the period of return down or loss occur. Sir, I am having the value of inventory of 100. I able to sold it for 110, 10 rupees profit. But if I able to sell it only for 95, then 5 rupees it's loss. It is gross loss. It is a loss and should be considered in the books of account. Amount of any reversal of any return on it. So it should be included in P&L account. They are saying you can put in P&L account. You should not go and adjust it in capital accounts. Example, revaluation account you should not touch. So sometimes asset we turn a building, you have it and you valued for 1 crore rupees. You sold it for 1.5 crores. This 0.5 crores, it's gain. But if you have revaluation, you have revaluated or devaluated, you can adjust it and then come to books. Okay. So that kind of things are in the books of account. You should not mix up accounting with taxation. Total, these are two different branches. So accounting may be totally different, taxation may be totally different. So in this is in the case of the inventory, we should follow this. This has been said. Taxation is derived based on accounting. I am not denying it, but sometimes taxation have an exceptional clause arising from the increase in net realizable value, the amount of any reversal. Sorry, I will come again here. This point. The amount of any reversal of return down of an inventory. So return down is reversed. Arising from the increase in net realizable value shall be recognized as a reduction in the amount of inventory, recognized as expenses in the period in which is reversal occur. So if the reversal is occurs and that reversal is increase in net realizable value, then the amount that is increased should be amount should be increased should be recognizes a reduction in the amount of there is a reduction in amount of inventory, then that reduction should be considered as expenses. Oh, you're having inventory, that same inventory this year one thing, next year realizables for value of inventory is falling, then what you'll do, it should be considered as expenses. Okay. Cost formula, what is the cost formula? The cost of inventory of item that is not ordinarily interchangeable, and the goods and service produced and segregated of specific project should be assigned by using specific identification of the individual cost. So what they are saying, so cost of inventory we having that are not ordinarily interchangeable. You can't interchange it every year. And goods and service produced and segregated for specific product shall be assigned by using specific identification of the individual cost. So you have the inventory for this project. It should be there for that project alone. You should not interchange like that. It should be kept in that way, that value. The specific identification of cost means specific cost is attributable to specific to identify the item of inventory. So this block of A, B, C, in a block of we have inventory items. So for this, the value is this much. And for this block, this is the value of inventory. For this is the block of inventory. You need to identify each of the product. If it's subjected to audit, subject to inquiry, subject to department ask, we should be able to say that. The cost of inventories other than the above shall be assigned to using first in, first out, and weighted average cost formula. First in, first out, now I bought this goods and kept this one, two, three, four. So I sold two. Now the value of goods is two plus three plus four. You can ask. You can't put completely. Sometimes I have one, three, two, and four. Here, this is 5 kg, 5 kg, 5 kg, and 5 kg. So what happens right now is, even though sold some block, I don't know what is the goods I sold, but I want to value it. All I will do is I sold around 10 units. I sold that maybe from 4, 3 to 1 block they sold. But how I value is, I will take first I will remove first block 5 and second block 5 I will remove. That is 10 out now. The valuation of inventory on 31st March will be the block value of 3 plus 4, that is 5 plus 5. Even though I take whatever the block I sold, I will value it based upon first in first out. Weighted average cost formula is, I don't know, sir. I don't want to have this problem, this invoice and all. So whatever the goods, number of units into a value of units, I'll put the value. Then sold number sales I'll put units. I will remove. And what is then after I will see how much value of units I have right now. I have 40 units. What is the average price of this? That into average weighted price of the goods. You multiply this, I will get the weighted average of cost formula. This is the thing, weighted average formula. I will repeat it. You should have a clarity. What I will do, not like first must out. This weighted average will be, sir, 10 units and price 550. Then 10 I got 660. Then 10 I got 770. So I have 30 goods totally varying 130, 130, 170. This is the value of goods. I sold 20 goods. Okay, I have remaining 10. What is the value of remaining 10? I will see yours. 170 by 30 into 10. 5, 6, 6, 7. So the value of good is 10 into 56.67. This is the value of weighted average goods. That's it. I don't care because this is the value. If it in the case of first in first out, the value will be totally different. But in the case of I'm taking weighted average, this is the value. This is how I will compute. Uh, Thank you. Bye bye.